Welcome to Taking Stock for the week ending the 25th of June 2021, where today Matthew Swartz, our portfolio manager, and myself, Kien, Trinh, stream to you all things share market. As we head into the end of the financial year, we've begun to see this rotation back into quality and growth investing. About a month ago, we spoke about the market cycle and how it's reached a peak in the recovery phase, and the global economy is now in a slowdown phase. And this is reflected in the number of leading indicators we've been monitoring, including the OECD and Westpac Melbourne Institute leading index. And this slowdown is also evident in China, with its economic growth rate and credit markets also easing in the last few months.
What this means is that the easy gains, especially across those speculative stocks, have probably been made. Share market returns aren't expected to continue on this accelerated path from here, but we continue to be broadly positive on the back of the low interest rate environment, as you spoke to, global vaccine rollout, continued quantitative easing, and some government stimulus. Also, during the phase of the cycle, the whole value v growth narrative becomes more evenly balanced, and we think risk appetite will tend to fall back to the defensives, quality and growth stocks, and this has been evident over the month with tech stocks, REITs, staples, discretionary and healthcare all outperforming over this month.
Yeah, that's right, Matt. One of our key philosophies is that investing in speculative high-risk stocks and assets is unsustainable. Just this week, we saw significant downside volatility in cryptocurrencies as China and also Iran, they cracked down on cryptocurrency services. And then as a result, we've seen Bitcoin and Dogecoin, they've now lost more than 50 and 70% respectively from their highs earlier in the year. And within the Australian market, we've seen some unhealthy stocks also fall in similar fashion, and such as companies like smart data analytics company Nuix, split payments company called Splitit, and also cloud-based communications platform Whisper as well. So we're not saying that these stocks won't be successful, but they do have a lot of risk attached to them at the moment. And now with Sydney also at risk of renewed lockdowns, companies within the travel and tourism industry are also vulnerable. And these include Hello World, Flight Centre, and even corporate travel.
And also bear in mind, as the end of financial year quickly approaches, we also need to be mindful of the trend in tax loss selling, which can accentuate weakness across some of the poorer performing stocks over the year. By selling losses, investors can reduce their net capital gains liabilities for the year. So our portfolio manager tool is very useful for this. So make sure you all have your stocks updated in Stock Doctor.
And the easy money is also expected to wind down as the US Fed alludes to an eventual tapering to its 120 billion per month asset purchase plan. They also plan to pull forward their expectations for the next interest rate hike to occur in 2022. And here in Australia, the Commonwealth Bank has announced that they expect the RBA to begin hiking interest rates late next year. But what does this all really mean, though? When you think about it, the easing of bond purchases by central banks suggests that the economy is close to a full recovery. Historically, when you've got low and rising interest rates, they tend to be associated with rising equity prices. And this is because rising interest rates are a function of inflation and economic growth. And with interest rates still low and above GDP growth on the horizon, we expect corporate earnings to grow at an above average rate for the remainder of the calendar year. Let's now turn our attention to a number of star stock developments over the month. We should be familiar with Adairs, which is a retailer of homeware such as bath towels and bed sheets. And the company mentioned that they will push forward their 35% purchase of Mocka. Remember, Mocka is a New Zealand-based online homewares retailer, and this acquisition was aimed at differentiating Adairs' product range, boost its sales in New Zealand, and also accelerate its online sales channel.
And the update during the week suggests that the FY21 earnings for Mocka will be around 12% below market expectations. And this did obviously contribute to the negative share price sentiment that we observed over the week. However, if we do step back and have a look at the business holistically, Mocka only really represents 12% of total group earnings. Hence, the likely impact at a group level for Adairs is only 2%. So this tends to, or we certainly view this 10% sell down as rather excessive given that context.
And from an income perspective, the decline in financial year 22 earnings and free cash flows reflect a normalisation of the extraordinary sales period experienced by most retailers during COVID. Even though the market expects dividends to fall from 27 cents per share to 25 cents per share in financial year 22, a forward gross dividend yield of above 8% remains highly attractive. Moreover, a forecast rise in the payout ratio from 62% to 69% lies within management's target payout range.
Yeah, look, and adding to that confidence is the sustainability of those distributions where free cash flow is more than adequately covering the payout. And from a fund perspective, we obviously like the business and we continue to hold in the Lincoln Australian Growth and Income funds.
Moving across now to the financials, Star Income stock Commonwealth Bank, they announced the sale of its general insurance business to Hollard Group for $625 million. Hollard Group is a privately owned insurance group based in South Africa, and the sale will improve the bank's capital position by about 9 basis points, with its common equity tier 1 ratio currently sitting at 12.7%. Now, flush with cash, along with a solid balance sheet, there is potential for the bank to announce a buyback of at least $5 billion or even pay a special dividend. And this could help bolster the dividend yield, currently sitting at around 5%, but that's the lowest among the big four.
And dividends aside there, the sale of this general insurance division could result in some higher competition within the insurance sector itself, particularly around policy pricing, as the Hollard Group will surely try to grow its market share within Australia. This could be a headwind for fellow Star Income stocks such as Suncorp, as margins could be squeezed from higher price competition. Although we don't think this will occur until at least financial year 23. Suncorp does remain on an attractive gross dividend yield of 7%.
Yeah, so we'll be monitoring that risk quite closely, Matt. But also in the banking space, Westpac, they confirmed that they'll be retaining their New Zealand operations. Remember, last year, New Zealand regulators, they lifted capital requirements for banks in the region from 4.5% to 13.5%. And what this means is that higher capital requirements are unlikely to impact dividends in the near term, but could prove a headwind to dividend growth from financial year 22 when capital requirements in New Zealand start to rise over that 7-year period. Note, however, that Westpac's revenue exposure to New Zealand is limited to only around 11%. Meanwhile, the bank is expected to pay a gross dividend yield of 6.4%.
And shifting our attention now to the Australian healthcare behemoth CSL, a stock that has recovered strongly over this quarter, although the share price has taken a bit of a tumble during the week. In monitoring the active risks, we are aware that the US Customs and Border Protection will disallow Mexican citizens from entering the US to donate blood plasma. This change in legislation has the potential to reduce the overall blood plasma supply in the US. Currently, CSL has 15 centres located near the Mexican border, representing about 5% of the company's US-based collection centres numbers.
And industry data that we've been monitoring also point to weaker foot traffic at CSL's Texas collection centres over the past week. But we are monitoring the situation quite closely, though initial feedback does suggest that the change has only had a marginal effect on their blood plasma supply chain.
And plasma headwinds aside, CSL announced a promising phase 3 trial of its gene therapy product for patients with haemophilia B. Guidance for the new product launch in the calendar year 2022 remains on track. Hence, we see the recent share price pullback as an opportunity to gain a position in a quality healthcare play, and we do retain a holding within our Lincoln Growth Fund and also in our Lincoln Australian Income Fund.
Yeah, thanks, Matt. Now, turning our attention to our corporate calendar, Collins Foods is expected to report its full year results on Tuesday, the 29th of June. Additionally, most of those REITs and a utility company called APA Group, they are due to expect to go ex-dividend on also the Tuesday, the 29th of June. And for those trend-sensitive investors, only one stock turned bullish on the SD Max. That's the Stock Doctor moving average crossover during the week, and that stock is Breville Group. This week, we want to focus on borderline star growth stock and star income stock Woolworths, with its demerger of Endeavour Group, which owns bottle shop chains Dan Murphy's, BWS, and a Pokies business. Now, post the demerger, Endeavour Drinks will own the largest network of retail alcohol stores in Australia with 1,630 stores. The transaction has created two independent ASX-listed companies and is very similar to what occurred when Wesfarmers they spun off Coles in 2018. To put things into perspective, Endeavour Group includes Endeavour Drinks and Hotel and contribute about 17% to Woolworths' total revenue.
Yeah, and management sees the split as an opportunity for both of these businesses to focus on their core strengths. And I think there's also an ethical / ESG layer here where that might tend to lead to high valuations for Woolworths. With the demerger of gambling and alcohol businesses, the ethical funds are far more likely to view Woolworths far more favourably moving forward.
And we also feel the spin-off makes sense from an income perspective, Matt, because the group's capital expenditure is not constrained by the investment in its drinks and hotel business. The split would allow each business to prioritise their growth, and with it, a high ability to pay dividends to shareholders. We anticipate the payout ratio to hold steady at between 70 to 75%.
As we're all aware too, the new shares began trading on the ASX yesterday, the 24th of June, with the stock closing the day at a market valuation of just under 11 billion. We believe the outlook for Endeavour is fairly positive. Hotels will benefit from the economic reopening, and that business represents about 23% of the new entity's total earnings. Meanwhile, earnings from liquor, BWS Dan Murphy's are very defensive and much more profitable than the liquor businesses of, say, a Coles. However, there are some risks on the horizon with potential introduction of cashless cards to curb the problem gambling issues. Also, there are regulatory caps and restrictions on electronic gaming, which may further constrain growth. Therefore, we believe earnings growth will be there, but limited in single digits over the coming years.
Yeah, and in terms of Endeavour's financial health, although we don't have full transparency at the moment until they release their financials in August, if you include their lease liabilities, their net debt to equity ratio is quite high at 160%. However, they have a defensive earnings stream in liquor, and they do have solid cash flows and a strong market position, and that should offset some of this risk to the business. The gross dividend yield is currently at around about 4%, which is expected to be higher than those from Woolworths. But for now, we retain the company under coverage until the financials are released in August.
And similarly here, from a yield perspective, from an income fund perspective, we see or are encouraged by the sustainability of dividends for both Woolworths and Endeavour, with management having indicated to expect similar payout ratios moving forward, which you alluded to before there, Kien. And as an added bonus for income-seeking investors, we expect Woolworths to announce some form of capital management, probably in the form of an off-market share buyback of about 1.5 to 2 billion. Now, for those that can get full utility out of franking credits, these events can be quite rewarding.
And in keeping with the spin-off theme from Woolworths, the key question this week is, what exactly is a spin-off and how does it differ from other forms of divestments such as a trade sale? It would also be interesting to reflect on the historical performance of both the parent and demerged entity following the demerger. Now, under a spin-off scenario, the parent company distributes shares off the subsidiary on a pro rata basis to shareholders. In the case of Woolworths, the subsidiary is Endeavour Group, and shares were issued on a one-for-one basis.
Now, the parent company typically receives no cash consideration for the demerged business. The spun-off company is a distinct entity from the parent company and tends to have its own management team. The parent company can offload either 100% of the shares to its shareholders or spin off majority to shareholders but continue to hold a minority interest. Now, in the case of Woolworths, the company has decided to retain a key stake of 15% in Endeavour Group.
And another option instead of a demerger is a trade sale, which is the process where the parent company seeks to sell the subsidiary to a third party and typically involves a cash transaction. In the case of Endeavour Group, the standalone value for the company is approximately between 9.3 to 12.5 billion. And this is substantial, and it means that there are limited strategic buyers, therefore making a trade sale like this unlikely to be successful. Hence, in the case of Woolworths, a demerger appears to be the best option. Also, it would be interesting to see what the performance of these demerged entities been like throughout history.
Interestingly enough there, Ken, analysis of demerged businesses in Australia has found that the performance of the demerged entity and the parent company tend to underperform up to about 150 days post the demerger. However, after this period, the market tends to better understand the value added, and both companies tend to outperform from there on.
Yeah, very interesting, Matt, and thanks again for sharing with us your insights today.
My pleasure. Thank you for having me.
So as we approach the end of the financial year, it's prudent for investors to reassess their portfolio and have strategies in place to minimize their tax by offsetting gains with losses. The portfolio manager and stock doctor can help you do this. Also, at this stage of the market cycle, we believe the argument between growth and value is now more evenly balanced. Just be careful of investing in those unhealthy businesses as risk appetite begins to fall. But also, make sure you tune into our Taking Stock video next week, where our Managing Director and Chief Investment Officer, Tim Lincoln, will join us to wrap up the end of financial year and also speak to you about the enhancements to our existing Star Growth stock selection model. Also, don't forget our Stock Doctor end of financial year offer that's about to end pretty soon. Have a happy, healthy, and prosperous week, everyone.